Welcome to the desk, Junior Analyst. Go ahead and pull up a chair. Today, we're putting away all those theoretical pie-in-the-sky fantasies and stepping into the actual reality of the financial markets. In this explainer, we're going to look closely at what really separates the seasoned pros from the gamblers. I'm going to walk you through exactly how to track the footprints of big institutional money, all while making sure you don't fall into the classic traps that wipe out most beginners. So let's dive right into this, shall we? Look, before we risk a single dollar of actual capital, I have to ask you a seriously important question. Do you truly believe that just drawing standard lines and throwing a few basic indicators on a chart can consistently outsmart a simple coin toss? Because most novice traders think a few hours of studying patterns basically guarantees them a yacht. But today, we're putting that assumption through an empirical reality check. We're going to look at some hard, cold data that might just change how you view trading forever.
All right, here's our training syllabus for the day. 1. Welcome to the desk. 2. Decoding accumulation and distribution. 3. Spotting price divergence patterns. 4. The randomized trading reality. 5. Surviving non-trending markets. And 6. The senior analyst's verdict. Let's get moving.
Welcome to the desk, moving beyond the get-rich-quick myth. Moving into part 2, decoding accumulation and distribution, your core tool. Before you start blindly executing trades and risking your account, you need a serious reality check. What you read in those basic get-rich-quick trading paperbacks, they completely omit the brutal mathematical realities of the market. My job as your mentor is to strip away all that noise. We are going to focus on concrete data, robust indicators, and the very real dangers of relying on flawed technical setups. If you want to know what the market is actually doing, you have to look under the hood. So the absolute crucial starting point is understanding the accumulation distribution line, or ADL. The ADL looks at the proximity of closing prices to their highs and lows to figure out if accumulation, which just means buying, or distribution, which means selling, is occurring. Think of this formula as your secret weapon. It tells you whether big institutional money actually buying into a rally, or if they're just secretly distributing their shares to unsuspecting retail traders right before a crash. To really master the ADL, you've got to burn John Murphy's rule number 10 into your brain. Volume precedes price. Let me pose a Socratic question to you. If a stock's price is rocketing up to new, exciting highs, but the trading volume is just completely drying up, who is actually buying? The answer? Nobody of consequence. The heavy hitters have already left the building. Heavy volume must take place in the direction of the prevailing trend to actually confirm it. If it doesn't, you are looking straight at a trap. Which brings us to part 3, spotting price divergence patterns. Let's look at the visual proof. Let's see how all this builds into actual actionable intelligence. Look closely at what we have here. Up top, you can see the price making clear, new, higher highs. It looks like a beautiful, incredibly healthy uptrend, right? But now look down at those green ADL volume bars. As the price goes up, the ADL is sloping downwards. This right here is called negative divergence. It's practically screaming at us that the buying pressure is a total mirage. The smart money is distributing. This is a classic trap, and spotting it is exactly how you identify the moment a trend is completely exhausted and ready to collapse. It's how you avoid buying the top just before the floor totally falls out. If you want to trade this consistently for real profitability, you can't just rely on gut feelings. You need strict rules. So here is your mentor's divergence checklist. First, track the price making new higher highs. Second, simultaneously observe your ADL indicator to see if it's sloping downward. Third, definitively confirm that negative divergence is present. And finally, anticipate trend exhaustion and a major price drop. Do not take a long position when this divergence is present. Following this checklist is a massive pro to your strategy, but the con is pretty simple. If you ignore these rules, the ADL is completely useless to you. All right, part 4, the randomized trading reality. Get ready for the academic slap. It is time to drop the illusion that technical indicators are some kind of magic crystal ball. These academics didn't just casually glance at a few charts. They rigorously backtested over 15,000 technical trading setups across an entire decade at the University of Lausanne and ETH Zurich. They literally pitted technical trading strategies against a randomized trading strategy, essentially pure blind luck. They wanted to know once and for all, does strictly following technical analysis actually beat just throwing darts at a board? Now check out how brutally this data contrasts. Just look at the minimum risk-adjusted returns. The randomized strategy, again, pure luck, actually performed better at its minimum than the technical strategies did. No way, right? The researchers found that absolutely none of the tested technical strategies reliably generated skill-based excess profits. And worse yet, they found that poorly optimized technical setups can actually generate consistent, statistically significant losses. Blind luck outperformed bad technicals. This means that blindly following an indicator without context isn't just ineffective, it's actively destructive to your account. Part 5. Surviving non-trending markets. It's all about market context. The huge takeaway from that academic study is that indicators like the ADL aren't magic wands that work everywhere all the time. Their success depends entirely on correctly identifying the overall market environment. Context is quite literally everything. Look at these two scenarios side by side. On the left, we've got a clear ascending uptrend with higher highs and higher lows. This is where trend-following indicators absolutely shine. But on the right, you see a choppy, sideways market. It's a trading range. If you try to force trend-following systems or momentum crossovers in a sideways, trendless market, you're going to get whipsawed, meaning you'll be tricked into buying high and selling low over and over, and the market will just bleed your account dry with false signals. You absolutely must adapt your tools to the environment. And why does that matter so much? Well, because of this number right here, 1/3. Technical master John Murphy gives us a conservative estimate that prices move in a flat, trendless, horizontal pattern at least 1/3 of the time. Think about that. For a third of the year, the market is in a state of relative balance between supply and demand. If you don't realize when you are in that 1/3, you are going to give back every single dime of the profits you made during the actual trends. Finally, part 6, the senior analyst's verdict. Let's look at the blueprint. So we've covered the power of the accumulation distribution line, the extreme dangers of negative divergence, and the academic reality of market randomness. Now it's time to bring this entire lesson together. Here are your marching orders, analyst. Every single morning, you follow this exact routine. Step 1, broadly identify if the market is actually trending or if it's stuck in a flat, sideways phase. Step 2, if we're trending higher, check the ADL line to ensure volume actually confirms the price and scan closely for any dangerous negative divergence. Step 3, always manage your downside risk, knowing full well that academic data proves bad technical setups will actively destroy your capital. Proper context and ruthless risk management, that's what separates the professionals from the gamblers. I want to conclude your training today by leaving you with this profound, incredibly sobering quote straight from that Swiss study. None of the tested strategies are expected to consistently generate skill-based excess profits compared to the market. Let that sink in for a minute. Indicators like ADL are incredibly powerful tools for managing risk and spotting traps, but they are not an ATM machine. You'll have to respect the market's randomness, strictly use your checklist, and above all else, protect your capital. Because honestly, if cold hard data proves that a simple coin toss can beat a bad chart setup, the real question you have to ask yourself is, what is your actual edge out there?